All right, let's unpack this. We're about to embark on a deep dive into a part of personal finance that honestly can trigger some negative feelings for a lot of us.
Hmm.
When you hear the word debt, what's the first thing that comes to mind? Probably credit card bills, student loans, mortgages, things you owe.
Yeah, things that maybe feel stressful or overwhelming.
Exactly. But what if we flip that script? What if we talked about debt that you own?
Right. And that's the core idea we're exploring today, and we're guided by some excellent source material here. We're working with key sections, specifically pages 88 through 104 of Nicole Lapin's insightful book, The Money School.
The money school. Yeah, Lapin is fantastic at making these complex financial ideas feel accessible, almost like a practical workshop.
Definitely.
So our mission in this deep dive is really to extract the most important insights from these pages to help you understand a fundamental area of investing fixed income. And within that, we're focusing specifically on certificates of deposit, or CDs.
Hmm.
The goal isn't just to define terms, though we'll do that, but to help you see how debt, from a different perspective, can become a strategic tool in your financial toolkit.
We want to help you move from feeling maybe fear or stress when you hear debt
Yeah.
to seeing it as an opportunity,
hmm
an opportunity to be the lender, to actually profit from it.
Let's jump right into that foundational shift in perspective then, what we'll call fixed income 101. The immediate barrier for many, like we said, is that word debt.
Yeah.
Because of personal experience or just, cultural messaging, most of us, me included, have a lot of financial trauma around the word debt, as the source puts it on page 88.
That negative association is completely understandable. You think of high interest rates you're paying, the pressure of repayments. But the absolute key distinction the book highlights right there early on is this. When you are investing in debt, you are not getting into debt yourself.
You're on the other side of the table.
Exactly.
You are the one providing the money. You are owed, not owing. You're the creditor.
Precisely. And this shifts the entire dynamic. It's quite powerful when you think about it. On Wall Street, they even have a different term for this kind of investment. They call it paper.
Ah, yes. This is one of those places where the money school brings in a bit of fun, comparing it to pop culture. As Lapin points out, in a rap song, getting paper means getting money, right?
Yeah.
Cash.
Right. But in the investing world,
It's different.
yeah, to someone in the investing world, the source notes, again on page 88, all those song lyrics about getting paper means getting into debt. But here's where the magic happens, as she puts it. Owning paper means owning someone else's debt, which, abracadabra, turns it into an asset for you.
Abracadabra. I love that reframe, turning something we usually see as a burden into an asset. It's just a perspective shift.
Completely.
Now, in this part of the money school, these pages 88 to 104, the book introduces two main ways you can buy this paper, this fixed income asset. One is through banks, which is where CDs come in.
Yes, and the book says this allows you to turn the tables and profit from lending your bank money rather than the traditional other way around. That's the core idea for CDs.
Okay, and the other way.
The other primary way discussed in the book, though in different sections, is through bonds. Specifically, government bonds are covered in Course 201 and corporate bonds in 301. But our focus today, sticking strictly to the pages provided to this deep dive, is on the bank side, on CDs.
Got it. So for the next little while, we're diving deep into making you comfortable, maybe even strategic, with the idea of being the lender, using certificates of deposit as our main example. We're transforming that narrative around debt from, fear to empowerment.
So moving into the practical side of how you become a lender through a bank, the source introduces certificates of deposit, CDs. They are, as the book describes them, pretty vanilla investments.
Vanilla. And yes, thankfully, the author did promise on page 89 to spare us the compact disc jokes.
We appreciate that.
So what exactly is this vanilla investment? What's the basic mechanism here?
Okay, the definition is straightforward. CDs are a type of fixed income investment offered by banks and credit unions. When you buy one, you deposit a lump sum of money.
Okay, a chunk of cash.
Right. And in exchange, you agree to leave that money untouched with the bank for a specific predetermined period. That's known as the term.
And the term could be short, like a few months, or longer.
Exactly. Could be anywhere from, say, 3 months up to 5 years, sometimes even longer.
And for your commitment, for leaving the money there?
The bank agrees to pay you interest. And crucially, it's at a specified rate for that entire term. And importantly, that rate is typically higher than what you'd earn in just a standard savings account.
Okay, so that's the incentive. Higher rate for locking it up. Why call them vanilla, though?
Because once you buy a traditional CD, The book says they offer a guaranteed return with a fixed interest rate no matter what the market is doing.
Predictability.
Exactly. You know precisely what interest rate you'll receive for the whole duration of the term, and you know exactly how much money you'll have at maturity when the term ends. It's simple, predictable, and generally considered very safe.
That predictability and safety are definitely key selling points. And that brings us to an absolutely crucial safety feature, one that the source emphasizes, especially on page 90, as gaining renewed importance recently. FDIC insurance.
This is huge. Non-negotiable really when considering where to put your money in a bank product like a CD. FDIC stands for the Federal Deposit Insurance Corporation. Its fundamental role is to protect deposits in member banks.
And the magic number everyone knows, or should know, is $250,000.
Correct. FDIC insurance covers deposits up to $250,000 per depositor per FDIC-insured bank for each account ownership category.
Okay, account ownership category. The book digs into what that means, right? Because it's not just $250K per CD account you open.
Right, that's a common point of confusion.
Yeah.
It's $250K total across certain categories at one bank.
Yeah.
The book clarifies this well. Standard deposit accounts like your checking, your savings, and your CDs are typically grouped together under the single ownership category.
So if I have, say, $50,000 in checking and a $200,000 CD at the same bank,
then your total is $250,000, and that full amount is covered under that single ownership category of that bank.
okay.
But if you then open a separate joint account with, say, your spouse at that same bank, that joint account is a different ownership category. It gets its own separate $250,000 layer of coverage for each owner.
Ah, so that's how people with more significant funds can maximize coverage, by using different ownership categories or different banks.
Exactly. Or by simply spreading funds across multiple FDIC-insured institutions. You get the $250,000 coverage limit at each separate bank.
That's good to know. And the source makes a really vital clarification about what this insurance actually protects against. It's not everything.
No, and this is critical. It only covers losses in the event of a bank failure, the book states clearly on page 90. It does not cover losses due to theft or fraud.
That's a big distinction. So if someone hacks my account, FDIC isn't stepping in.
Correct. That's a different issue, usually handled through bank security protocols or other types of insurance. FDIC is purely protection against the bank itself going under, collapsing.
And the source, on page 91, reflects on how the perception of this insurance has really shifted over time. It says, in years past, mentioning FDIC insurance would be a throwaway point because banks didn't fail.
Yeah, it felt like a theoretical safety net for a long time. But then, as history showed us, they did. The source specifically highlights the 2008 financial crisis.
Right, a huge turning point.
Banks that no one ever thought could possibly fail did, the book recalls, naming major players like Lehman Brothers, Bear Stearns, and Washington Mutual.
And others needed massive help. Wachovia and Merrill Lynch were sold off in a fire sale, and Citigroup required huge government bailouts. That whole period really shook confidence.
It certainly made FDIC insurance, as the source puts it, far from an afterthought. It became very real very quickly for a lot of people.
And then it happened again, didn't it? More recently.
Yeah, just a little over a decade later. The source points to the wave of bank collapses seemingly out of nowhere in 2023.
Naming Silicon Valley Bank, Signature Bank, and First Republic Bank. These weren't small players either.
No, and these events really underscore the book's conclusion on this topic. Now, FDIC insurance is far from an afterthought. It's something very real to consider in a world where no bank is too big or mighty to fail. It's a sobering reminder, right? Even in a highly regulated system, risks exist, and understanding this protection is vital.
Absolutely. So FDIC insurance is your backstop against the bank itself failing, up to those specific limits depending on how you structure things. That definitely provides a level of confidence in using bank products like CDs.
It does.
Which naturally leads to the next question. Once you hand over your money for that CD, what does the bank actually do with it? It's not just sitting in a vault, is it?
No, despite the movie images. The book has a fun bit about this on page 92 saying, I know you might think when you put your money in a bank, it's sitting there behind a cinematic bronze vault. Hate to break it to you, but it's not.
Huh. Okay. A little disappointing maybe, but probably more realistic. So where does it go then?
It's being put to work, making more money for the bank. Banks operate on what's called fractional reserve banking. They only need to keep a certain fraction of deposits on hand for day-to-day withdrawals.
Okay, so they keep enough liquid cash to meet normal customer demands, but the vast majority is deployed elsewhere.
Exactly. Their business is right. They're trying to live up to their names and make bank here, which means putting your money to work. And the main way they do this is by lending out and investing the money that you and other depositors provide.
So they're taking our collective deposits from savings, checking, CDs, and turning them into loans, mortgages. What else?
The book mentions they also invest in bonds and the stock market to try and get a big fat return from it. So your CD money, while it's locked up and earning you a fixed interest rate, is part of a much larger pool the bank is actively using to generate its own income.
And this is fundamentally how the bank makes its profit.
Absolutely. It all comes down to the interest rate spread, as explained on page 92. The bank pays you a relatively low interest rate for your deposit to your loan to them, essentially via your CD or savings account.
Right.
But then they turn around and charge a much higher interest rate when they lend that same pool of money out to someone else through a mortgage, a car loan, a business loan.
That difference, that gap between the low rate they pay depositors and the high rate they charge borrowers, that's their profit margin.
Precisely. It's the bank's bread and butter, as the source calls it. By leveraging your money in this way, banks can use your money to make money while also funding everyone's loans. It's the core of their business model.
Understanding that definitely makes you feel a bit more like, a participant in the system rather than just a passive customer handing over cash.
Yeah, you're providing the capital they work with.
So, okay, if you're ready to be that lender to the bank by buying a CD, how do you pick the right one? The source, around page 93, frames it like choosing a significant commitment.
Yeah, it's important to find a CD that really aligns with your needs and your goals. When you're picking a CD, it's important to make sure you and your CD are aligned so that it can meet your needs and help you achieve your goals.
And the key factors for that alignment.
The book highlights three main things: the term length, interest rate, and minimum deposit requirement.
So it's not just about chasing the absolute highest interest rate you can find.
Not at all. Actually, the term length is arguably paramount. If you know you'll need that money back in, say, 2 years for a specific goal.
Like a down payment, maybe.
Right. Locking it into a 5-year CD, even if the rate looks tempting, would be a mistake, especially if that CD has stiff penalties for early withdrawal. As the book warns, that's simply not the CD for you. You need a term that matches your financial horizon for that specific pot of money.
Okay, so step one, match the term length to when you anticipate needing the funds. Once you know the term you want, say 1 year or 3 years, how do you go about finding the best options?
The most effective strategy is simply to shop around. Don't just default to the bank where you have your checking account.
The source explicitly encourages breaking up with bank loyalty here, right?
It does. It says, don't worry about banking monogamy here. Page 93 again. It's perfectly fine, even potentially advantageous, to open a CD account at a completely different bank or credit union.
Why might that be advantageous, besides maybe getting a better rate?
Well, the rate is a big one, but also it may even be a good idea in order to ensure you'll be fully protected by FDIC insurance, especially if you have deposits that might exceed the $250,000 limit at your primary institution. Spreading funds across different banks maximizes your total FDIC coverage.
Good point. Brings us back to FDIC. So where can you effectively shop around?
The source suggests leveraging online comparison tools. It mentions Bankrate, NerdWallet, and The Motley Fool on page 94. These platforms aggregate CD rates from many different institutions, banks, credit unions, online banks, making it really easy to compare terms and annual percentage yields, or APY.
And are those online banks usually the best bet for rates? They often seem to have higher numbers.
Often they do, largely because they have lower overhead, cost no big branch networks to maintain. But the source also gives a good tip about looking locally. Don't forget to search community branches. Credit unions in particular may beat all the big names in terms of the rates they offer.
Well, that's interesting. Why might a local credit union offer better rates than a huge national bank?
The key difference lies in their structure, as explained on page 94. Big banks have shareholders and profits to worry about because they are run as a business, often publicly traded. They need to generate profit for their shareholders.
Right.
Credit unions, however, are essentially owned by the clients, their members. They don't have to worry about profit margins in the same way, just paying their employees and operating costs.
Yeah.
This different structure allows them to potentially return more value to their members through higher deposit rates and sometimes lower loan rates, too.
That difference in operating philosophy can really translate directly into better terms for you, the saver. Is worth checking them out.
Definitely.
To illustrate just how much rates can vary, the source includes a sample table. I think it's on page 95, based on rates from the end of 2022.
Yes, it provides a great snapshot. It shows different rates across various fictional institutions like Bank A, Bank B, and Online Bank, Credit Union E for different terms.
Mhm.
For example, a 6-month CD might be offering, say, 1.40% APY at one large bank, but 2.50% APY at an online bank or credit union in that example.
Wow, that's a significant difference on the same term length.
It is. And similarly, a 5-year CD could range from maybe 2.25% at one place up to 3.50% APY somewhere else, according to that 2022 example table.
Seeing those variations visually just makes it crystal clear that shopping around isn't just, theoretical advice. It can mean a real difference in your actual returns.
Absolutely. And those rates are always quoted as APY, annual percentage yield.
Right. And APY is important because it accounts for compounding, right?
Yep.
Earning interest over the year.
Exactly.
Yeah.
A 2.5% APY on a 1-year CD means your total effective annual return, factoring in how often the interest compounds, is 2.5%. It gives you a standard way to compare offers.
And the source mentions you can use online calculators to project your gold you'll get at the other side, as it puts it, the total amount you'll receive at maturity, principal, plus all the interest earned.
Yeah, simple interest calculation, but a calculator makes it quick and easy to see the final number.
Okay, so we shop around, compare APYs for our chosen term. Understanding why these rates change and vary between different banks is also helpful context. The source says it's a mix of big picture and small picture factors.
Right, macro and micro influences.
Macro being the big economy-wide forces.
Precisely. The dominant macro influence, as stated on page 96, is the central bank's monetary policy and the current interest rate environment. This is fundamentally linked to what the Federal Reserve does.
So Fed actions impact CD rates.
Directly. The book explains. If interest rates are high, then mortgage rates and CDs would be too. If they are low, both debt instruments and others would be low too. When the Fed raises its target federal funds rate, banks generally raise the rates they offer on deposit products like CDs and also what they charge for loans. When the Fed cuts rates, CD rates tend to follow downwards.
Okay, so the overall interest rate climate set by the Fed is the biggest driver, and the micro factors, those are specific to the bank itself.
Yeah, things like, as the source puts it, just how much a bank can afford to pay you. This ties back to what we discussed earlier. The lower overhead of online banks or the different profit structure of credit unions might give them a bit more flexibility to offer slightly better rates than a large traditional bank with significant physical infrastructure and shareholder return pressures.
That makes sense. Now, the source, around page 96, points out a particularly interesting and kind of unusual situation with CD rates that occurred post-COVID.
Yes, this was a really fascinating dynamic in the market for a while there. There have been times, particularly post-COVID, where the CD yields for short-term CDs have been higher than those of long-term CDs.
Wait, shorter terms paid more than longer terms? That seems backwards.
It is. Normally, you expect to earn a higher rate for committing your money for a longer period, like 5 years versus 1 year. This unusual situation is called an inverted yield curve.
And the explanation for this inversion ties directly back to those macro factors, specifically what the market expected the Fed to do next.
Exactly. The book explains that as I'm writing this, which was likely sometime in late 2022 or early 2023, based on the context, short-term rates closely reflected the Fed's then current interest rate hikes. They were high because the Fed had been raising rates aggressively.
Okay.
But everyone expects the Fed to lower rates, or at least that was the strong anticipation in the market at that time. So banks didn't want to lock themselves into paying those high interest rates for 5 whole years if they believed the Fed was going to start cutting rates soon.
Because if the Fed cut rates, the banks would be stuck paying out a high rate on those 5-year CDs while the overall cost of borrowing money for them went down.
Precisely. They'd be paying more than they needed to down the line. So in anticipation of future rate cuts, they kept the long-term CD rates lower than the current short-term rates. It was a defensive move based on market expectations.
That's a really interesting example of how market outlook shapes these rates.
It is. And the source explicitly flags this as a very unusual situation and one that will likely change in the future, which really reinforces the point that you must constantly reevaluate the timeline of your financial goals and which CD terms are offering the best rates, because the market landscape isn't static. It can shift.
Absolutely. Okay, so you've done your research, Found a CD with the right term and a competitive rate, considered the bank's structure and the macro environment. Before you finalize that purchase, the book really stresses doing your due diligence on the specific offer.
Yes, absolutely crucial. You must read and review all the terms before purchasing. Page 97 emphasizes this. Double-check everything. The interest rate, APY, term length, withdrawal penalties, and renewal policies.
Those early withdrawal penalties can be significant, right? Like losing several months of interest.
They can be, yes. You need to know exactly what happens if you do need the money before maturity, even if you don't plan to. And the renewal policy is important too.
Okay, so you read the fine print, you buy the CD, what's next? Just file it away.
Keep your confirmation and any documentation somewhere safe, definitely. But importantly, as the source advises, keep an eye on your CD's maturity date. Calendar reminder.
Simple advice, but probably easy to forget, especially with a multi-year CD.
Very easy. Set a reminder a week or two before it matures. Because as that date approaches, you should decide whether you want to withdraw your funds or roll them over into a new CD.
And you need to be proactive about that decision.
Yes, because you need to be aware of your bank's automatic renewal policy. Often, if you do nothing, the bank will automatically roll your matured CD, the principal, plus the interest, into a new CD of the same term length.
But at whatever the current interest rate is at that time.
Exactly. And that current rate might be much lower than the rate you were just earning, or maybe higher. Or maybe you want a different term length now. You need to actively notify the bank before maturity if you plan to withdraw the funds or roll them over into a different type of CD. Don't just let it happen automatically unless that's truly what you want.
Good practical tip. The source includes a fun little anecdote here, the Confessions of a Professor story on page 97, which perfectly illustrates the non-physical nature of these investments.
This story is great because it taps into that confusion some people might subconsciously have between a financial CD and, well, a music CD. The professor bought a certificate of deposit and, apparently being someone prone to losing things, asked the banker if it could get lost or copied like a physical disc.
Huh. Picturing someone asking for a backup copy of their CD investment like it's a data file or a music album.
Exactly. The banker was, understandably, a bit puzzled and had to patiently explain that these CDs are not physical objects like, well, a Walkman-esque CD, but are non-physical financial instruments.
But the professor apparently persisted.
Yes, asking if they could at least make a copy, maybe two copies, in case one gets lost. Which led to, apparently, a half-hour explanation that bank CDs are not only safe and secure, but also completely digital and cannot be copied or lost like a physical object. It's just a great, slightly humorous illustration that your investment is essentially a secure digital record within the bank system. It's safe from being physically misplaced or damaged like an old music CD.
Good way to visualize its security from that kind of risk. So safe from physical loss, yes. Safe from bank failure, yes, up to those FDIC limits we discussed. But as the source points out quite clearly on page 98, traditional CDs aren't completely risk-free. There's one primary risk, especially in certain economic environments.
And that primary risk is inflation. This is the big one for fixed-rate investments. If the rate of inflation is higher than the interest rate you're earning on your CD, then the real value or the purchasing power of your money decreases.
This is the core challenge, isn't it? You're guaranteed to get your principal back plus interest, but if the prices of goods and services have risen faster than your interest rate, the money you get back at maturity might actually buy you less stuff than your original principal could have.
Exactly. The source gives a clear illustration. If your CD pays 2% interest, but inflation is running hot at 3%, you're technically earning money in nominal terms, but your real purchasing power is actually shrinking by 1% per year. You're falling behind the rising cost of living.
And the book backs us up with a really compelling historical example from the early 1980s, mentioned on page 98.
Yeah, this is a stark reminder. Back then, we saw CDs with incredibly high interest rates, as big as the hair that was in style, the book jokes. Rates were as high as 17% returns here.
Wow, 17% on a guaranteed CD. That sounds absolutely amazing today.
It does, on the surface. Until you factor in the other side of the equation. This looks amazing until you factor in that for the same year, the inflation rate was 14.5%.
Ouch. So a massive 17% nominal return only translated to about a 2.5% real return after accounting for how much prices went up that year.
Exactly. The source's point is sharp. All of a sudden, those returns don't look nearly as impressive once inflation takes a bite out of your profits. It highlights that you always have to consider the rate of return relative to the rate of inflation to understand if your wealth is actually growing in real terms.
This makes understanding inflation itself pretty critical when you're thinking about fixed-rate investments like CDs. The source defines inflation simply on page 99 as the increase in prices over time for the things we buy, from lattes to laptops.
Yeah, the example given of movie tickets going from maybe $5 to $20 over the author's lifetime is a very relatable illustration of purchasing power erosion over time.
And deflation is just the opposite, prices going down.
Yes, deflation is what happens when stuff costs less than it used to. It's much less common than inflation, but has occurred during major economic downturns like the Great Depression and, to a lesser extent, the source notes, in the Great Recession after 2008.
Okay. The source briefly touches on why inflation happens, listing three main flavors on page 99.
Right. There's demand pull inflation, which happens when there's too much money chasing too few goods, basically. Consumer demand outstrips the available supply, pulling prices up. Think of a popular new smartphone launch with limited stock.
Got it. Then there's cost push.
Yes, cost push inflation. This happens when the costs of producing goods and services go up. Things like wages, raw materials, energy, and businesses pass those higher costs onto consumers in the form of higher prices. The book is examples like a hurricane impacting oil prices, which affects gas and transport costs, or a freeze damaging orange groves, leading to higher orange juice prices.
Makes sense. And the third flavor is built-in inflation, sometimes called the wage price spiral.
Yeah, this is more about expectations driving the cycle. If workers expect prices to keep rising, they demand higher wages to keep up. Businesses then raise their prices to cover those higher wage costs. This, in turn, makes workers expect prices to rise even further, leading them to demand even higher wages. And the cycle continues. It can become a self-fulfilling prophecy, as the source puts it.
Interesting how expectations play a role. The book notes that a little bit of inflation isn't necessarily a bad thing for the economy.
Right. A small, steady, predictable level of inflation, maybe around 2%, is generally considered normal and even good for a healthy economy because it encourages people and businesses to spend or invest money rather than just hoarding cash that's slowly losing value. It keeps the economic wheels turning.
But too much inflation.
Yeah, when it gets too high or unpredictable, it starts to hurt our wallets and can slow down economic growth because uncertainty rises and purchasing power erodes quickly.
And high inflation directly impacts the appeal of traditional CDs because that guaranteed fixed return might seriously lag behind rising prices. The source even suggests that in times of very high inflation, you might need to step away from CDs or look at alternative strategies that might offer better inflation protection.
True. So, how do you keep track of this inflation monster, as the book calls it?
The key metric discussed on page 100 is the Consumer Price Index, or CPI. The source describes it colorfully as a measure of a smorgasbord of different staple goods, think transportation, food, medical care, whose prices are tracked over time by the government.
And the CPI is really closely watched by economists, policymakers, and investors because it often moves in tandem with interest rates, right?
Yes, the book notes inflation and interest rates tend to move together. When inflation is running high, central banks, like the Fed, often raise interest rates to try and cool down the economy and curb price increases.
Conversely, during economic downturns or periods of very low inflation or deflation, the Fed might lower interest rates significantly to try and stimulate borrowing and spending.
So, tracking the CPI gives you valuable insight into the broader economic forces that are likely influencing the direction of CD rates offered by banks. You can find the official CPI data, the book mentions, on the Bureau of Labor Statistics website or reported widely by major financial news outlets.
Okay, so inflation is the main vulnerability, the primary risk of a traditional fixed-rate CD. What if you want the security and the fixed income aspect, but you want to try and mitigate that inflation risk? Or maybe you're worried about needing access to your money before the term is officially up.
Right, the two main drawbacks, inflation eating returns and lack of liquidity. The source introduces a popular strategy designed to address both of these issues, starting on page 101. It's called the CD ladder.
Ah, yes, the latter. It's presented as a smart strategy to, quote, escape inflation, or at least reduce its impact significantly, and also tackle that access problem.
How does it work? What's the core idea?
The core idea is actually pretty simple. Instead of putting all your investment money into just one single CD with one maturity date, you invest in CDs with different maturity dates. You spread your money across multiple CDs with staggered terms.
So you create different rungs on a ladder, maybe a 1-year CD, a 2-year, a 3-year, and so on, with roughly equal amounts in each.
Exactly. And the key mechanism, the real power of the ladder is this. As each CD matures, You can reinvest in a new CD at the current interest rate, which may be higher if inflation has risen.
Ah, okay. So if interest rates have climbed along with inflation since you first set up the ladder, when your shortest term CD matures, you get to reinvest that money at the new, higher prevailing rate.
Precisely. You're capturing those higher rates over time as each rung matures, rather than being locked into an old, potentially low rate for your entire investment for years and years.
So it acts as a hedge against being stuck in a low rate environment if rates start to rise. You get periodic chances to step up.
Yes. It helps smooth out your average rate of return over time by regularly giving you opportunities to reinvest at current market rates. But that's not the only major benefit. As the source notes, it also directly addresses the liquidity or access concern.
How so? Because you have money maturing periodically?
Exactly.
Yeah.
Because you regularly have CDs coming to maturity, you can get the benefits of investing in debt without all your money being locked up or taking the financial hit of cashing out early. Once the ladder is fully established, you have a portion of your total investment becoming liquid every year, or whatever interval you set up.
That seems really practical for money you know you'll need eventually, but maybe not all at once or not immediately. The book gives the example, I think, of saving for a down payment on your first house.
Right. You might need the bulk of the money in, say, 3 to 5 years, but perhaps you'll need smaller amounts sooner for things like closing costs or initial repairs or furnishings. A ladder provides both the potential for growth, especially if rates rise, and these planned access points without penalty.
It feels like a really smart compromise between tying up all your funds for potentially higher long-term rates
Yeah.
and needing some degree of liquidity along the way.
It really is. It offers a balance.
The source walks through a detailed example using those 2022 rates from the earlier table to illustrate exactly how a ladder works in practice. I believe this starts on page 101 as well.
Let's look at that example. It assumes you have $10,000 total to invest, and you decide to create a 5-rung ladder, dividing the money evenly.
Okay, so that's $2,000 in each CD, and the terms are staggered. A 1-year, a 2-year, a 3-year, a 4-year, and a 5-year CD.
Correct. And the example uses those specific APYs from the 2022 snapshot table for each initial rung. The 1-year CD at 2.5%, the 2-year at 2.75%, the 3-year at 3.0%, the 4-year at 3.25%, and the 5-year CD gets the highest initial rate at 3.5%.
So you buy all 5 of those at the same time. What happens after year 1?
After 1 year, that first $2,000 investment in the 1-year CD matures. Based on the 2.5% APY, it grows to $2,050, principal plus interest.
And this is where the laddering action really happens, right? What do you do with that $2,050?
Yes. Here's the key step. As each CD matures, and you decide you want to keep the ladder going strong, just reinvest the recently matured money into the new longest term of your ladder. For example, a new 5-year CD to maintain the structure.
Ah, so you take the $2,050 from the matured 1-year CD and you immediately reinvest it into a brand new 5-year CD, presumably at whatever the prevailing 5-year rate is at that moment 1 year later.
Exactly. That keeps the 5-rung structure intact. Then a year after that, 2 years from the start, the original 2-year CD matures.
Okay, so that initial $2,000 invested at 2.75% would mature into, let's see, about $2,111.
Right. Principal plus 2 years of interest at that rate, and then you take that $2,111 and reinvest it into another new 5-year CD at the then current rate.
And you just keep repeating this process. As the 3-year matures, reinvest in a 5-year. As the 4-year matures, reinvest in a 5-year. As the original 5-year matures, reinvest in a new 5-year.
Exactly. The example in the book simplifies things by showing the outcome. If you were to just run this forward using the initial rates for illustrative purposes, just to demonstrate how the capital grows and how that periodic maturity creates an income stream or reinvestment opportunity. It shows how the original $10,000 could generate a guaranteed return based on those initial rates, while giving you that annual payday, as the book calls it, as a portion matures every single year after the first year.
That's the real beauty of it, isn't it? Once the ladder is up and running, every year you have a chunk of money maturing. You have the option to take that cash if you need it for something, or you can reinvest it back into the longest rung, usually 5 years, to keep the ladder structure going and potentially benefit from current, possibly higher interest rates.
It provides that ongoing flexibility and the potential to capture rising rates over time.
The book provides a pretty simple step-by-step guide on page 102 for actually building your own ladder.
Yes, it breaks it down clearly. 1. First, determine your total investment amount. How much do you want to put into the ladder? 2. Second, decide on the ladder structure specifically, the number of rungs and the corresponding terms. A common approach is a 5-year ladder with annual rungs, meaning you'll need CDs with 1, 2, 3, 4, and 5-year terms. But you could do shorter ladders too. 3. Third, divide your total investment amount evenly across the number of rungs you decided on. Fourth, shop around for the best rates for each of those required term lengths, 1 year, 2 year, etc., and purchase the CDs. Make sure you understand the maturity instructions. Will they auto-renew or transfer the cash somewhere? Set them up how you want. 5. And fifth, monitor your maturity dates and maintain the ladder. As each CD matures, reinvest the funds into the longest term available, for example, a new 5-year CD, to keep the structure cycling forward. Periodically review if the strategy still makes sense for you.
That seems very manageable. So to recap the benefits of laddering, it gives you diversification across time and interest rate environments. You potentially benefit from rising rates when you reinvest. You get periodic access to your capital without penalty, and it helps mitigate reinvestment risk. You're not putting all your money into one rate at one potentially low point in the interest rate cycle.
Exactly. It's a really solid strategy for balancing safety, return potential, and liquidity when using CDs.
Okay, so beyond the vanilla traditional CD and the effective ladder strategy, the source then delves into some more specialized options. Starting around page 103, it calls these fancy CDs.
Right. These are presented as offering potential upgrades or being more like sophisticated sports cars compared to the reliable sedan of a traditional CD. They come with special features and unique benefits, but usually also some specific trade-offs or risks.
All right, let's explore these upgrades. First up on the list, brokered CDs. The key difference here seems to be how you buy them.
That's right. Brokered CDs are typically purchased through a brokerage firm, not directly from a bank. So instead of going to your local bank branch or website, you buy these through an account you have with a brokerage like Fidelity, Schwab, Merrill Lynch, etc.
Similar to how you'd buy stocks or bonds or mutual funds through that brokerage account.
Exactly. The source explains that brokered CDs are part of a larger pool of CDs from various banks, brought together under the umbrella of a brokerage. The brokerage firm acts as an intermediary, essentially shopping the market for you and offering you access to CDs issued by a wide range of different banks, not just the single bank whose products they might normally sell.
So that gives you potentially a lot more choice, right? You're not limited to just the rates and terms offered by your primary bank or even local credit unions.
Correct. While your local bank only offers their CDs, a brokerage can provide access to a diverse array of CDs from banks across the country, sometimes even globally. This can mean access to more competitive rates or a wider selection of maturity dates or specific features because the brokerage casts a wider net.
The source includes a little story here, doesn't it? About a friend who used brokered CDs after selling her company.
Yes, it's a relatable anecdote on page 103. A friend had a successful exit from her fashion company, had $25,000 she wanted to invest very safely, but was quite nervous about losing the money. She agreed to invest in a CD for safety, but her advisor helped her do it through her Merrill Lynch brokerage account rather than her regular Bank of America account.
And initially she panicked, thought she'd done something wrong because it wasn't directly with her bank.
Exactly. She freaked, thinking it wasn't a real CD. But her advisor reassured her it was basically the same thing, just a little, well, fancier variety, which apparently resonated with her fashion background. She replied, "Okay, yeah, well, that's definitely my style."
Huh. It's a good illustration that even sophisticated people can have anxiety around financial products, and sometimes these fancy options are just different ways of accessing or packaging the same core underlying investment, in this case, a bank-issued CD.
Precisely. And in terms of safety, that's a key question. Are they still FDIC insured?
Good question.
Yes, the source confirms. Most brokered CDs are FDIC insured up to the legal limit, just like traditional bank CDs. The insurance protection is with the issuing bank whose CD you ultimately own, not with the brokerage firm itself. The brokerage is simply the platform, the intermediary facilitating the purchase.
Okay, so the fundamental safety net is generally comparable, but they must have some unique features or risks compared to just buying directly from a bank. One perk mentioned is the ability to sell them before maturity.
This is a key potential advantage over traditional CDs. Traditional CDs usually hit you with an early withdrawal penalty if you need the money back before the term ends. Brokered CDs, however, can potentially be sold on the secondary market, much like you might sell a bond before its maturity date.
So that offers more flexibility if your circumstances change and you need liquidity unexpectedly.
Potentially, yes. It offers the possibility of liquidity without penalty. But, and this is But that flexibility comes with a potential downside and a specific risk.
Okay, what's the catch?
The book warns that the secondary market can be fickle. While you can try to sell your brokered CD, there's no guarantee you'll find a buyer quickly, or maybe even at all, depending on market conditions. And crucially, if you do find a buyer, you may have to sell your CD for less than your original investment.
So unlike a traditional CD where your principal is safe if you hold it to maturity, barring bank failure beyond FDIC limits, with a brokered CD, if you sell early on the secondary market, the market price you get could be less than what you originally paid.
Exactly. This introduces market risk to your principal if you sell early. This ties into interest rate risk, but in a different way than for traditional CDs.
So.
With a traditional CD, the main risk of rising interest rates is opportunity cost. You're stuck earning an older, lower rate, while new CDs offer more. Your principal itself is fine if you hold to maturity. With a brokered CD, if interest rates in the market rise after you buy your CD, your existing CD, with its now relatively lower interest rate, becomes less attractive to potential buyers on that secondary market.
Right, because why would someone buy your old 3% APY brokered CD from you when they can go out and buy a brand new CD directly offering 5% APY?
Precisely. To entice someone to buy your less attractive, lower-yielding CD, you'd likely have to offer it at a discount to its face value. You'd have to sell it for less than you paid, meaning you'd take a loss on your principal. So brokered CDs offer potential liquidity, but they introduce the risk of losing principal if you need to sell before maturity, especially if interest rates have risen since you bought it.
That's a really important trade-off to understand. Flexibility comes with market risk if exercised early. The source also advises reading the fine print carefully, as brokered CDs can sometimes have more intricate terms, and some may be callable, which is actually another type of fancy CD we'll get to.
Okay, moving on to the next type mentioned on page 103, jumbo CDs. As the name suggests, these are for larger investment amounts.
Right. They require a larger minimum deposit, often $100,000 or more, a big chunk of change.
The traditional primary draw for these was that banks would typically offer slightly higher interest rates than standard CDs as an incentive for that larger deposit commitment. However, the source includes an important caveat, noting that, at the time of writing at least, quote, the difference in rate of return on jumbo CDs versus regular CDs is fairly small, and so in some cases you would be better off with a traditional CD.
So again, don't just assume jumbo automatically means a better rate. You still absolutely need to shop around and compare the actual APYs offered for the term you want, whether it's labeled jumbo or traditional.
Absolutely. Check the specific numbers.
Where would someone typically find these jumbo CDs? Are they common?
The source describes them as more of a boutique offering. You'll usually find them at large and online banks, although some smaller regional banks or credit unions might also specialize in catering to clients with larger deposit needs.
How might a jumbo CD fit into someone's overall financial strategy then, especially if the rate isn't always dramatically better?
Well, if you have a very large sum of money you want to protect while earning a modest return, perhaps that $100,000 earmarked for a house down payment we talked about earlier, a jumbo CD can be a straightforward way to keep that specific pool of goal money safe and fully FDIC insured, assuming it's under the $250K limit at that particular bank while still earning some interest income. It's about principal preservation for a large specific sum.
And from the bank's perspective, why offer them?
Attracting these large deposits helps significantly boost their capital reserves, which gives them more capacity to make loans and investments. It's especially attractive for them when interest rates are high and lending is profitable.
Okay, got it. Next on the fancy list from page 103, the bump up CD. This one sounds like it directly addresses that fear of missing out, the FOMO if rates go up after you buy.
Exactly. This is the CD designed for people anxious about locking in a rate only to watch rates climb higher soon after. A bump up CD offers the option to increase your rate of return if the bank's rates for new CDs rise during your term.
So you get one or maybe more chances to say, hey, bank, your rates for new CDs like mine have gone up. I want that higher rate now.
Essentially, yes.
Yeah.
It acts as a hedge against rising interest rates and gives you that feeling of being able to, as the book puts it, have your cake and eat it too.
Yeah.
Locking in a rate but potentially benefiting from rising rate environment later without having to break your existing CD and pay a penalty.
That sounds like a fantastic feature. What's the catch? There's always a catch, right?
There usually is a trade-off. The catch here is that these CDs often start with a lower interest rate compared to their traditional counterparts of the same term length. You sacrifice some yield up front for the potential flexibility to bump up your rate later if market conditions allow.
And you probably can't just bump it up every time rates inch higher.
No, typically not. The book notes most only allow you to trade up once or twice during the CD's term. You really have to read the fine print to understand the specific rules. How much do rates have to rise to trigger the option? How many times can you exercise it? When doing the term can you do it? The details matter.
Okay, so a lower starting rate and limited bump opportunities are the trade-offs for that potential upside. How about step-up CDs? They sound related, but maybe slightly different.
They are related in addressing rising rates, but the mechanism is different, as explained on page 104. With step-up CDs, the interest rate increases at predetermined intervals throughout the term of the CD. It happens automatically based on a schedule set when you buy it. It's not an option you choose to exercise.
Ah, so it's like climbing a preset staircase of rates over the CD's term. Maybe it starts at 2%, then automatically steps up to 2.5% after a year, then 3% the year after that.
Exactly like that. This structure is appealing for when you want to invest in CDs, but you're sure that interest rates will rise before your CD matures. It's kind of a long-term bet on rising rates where the initial rate might be lower than a traditional CD, but the guaranteed automatic step-ups could result in a better overall average return over the life of the CD if rates indeed rise as anticipated when you bought it.
So bump up is optional and triggered by market changes. Step up is automatic and pre-scheduled. Both generally start with lower initial rates.
That's a good summary.
Okay, let's switch gears from rate flexibility to access flexibility. Liquid CDs, also on page 104, sound like they offer a way to get your money out early without the usual pain.
This is the CD, the source suggests, for someone whose fear of commitment isn't about rising interest rates, but more about the anxiety of locking up all your money for a fixed period. A liquid CD, sometimes called a no-penalty CD, sets itself apart from standard CDs by allowing you to withdraw some or all of your money before the maturity date without facing any penalties.
Wow, no penalty for early withdrawal. That seems to contradict the whole point of a CD locking up money.
It does seem like it, but it's a specific feature designed for a specific need. Now, the source clarifies it's not a free-for-all. There will likely be rules about how much and how often you can withdraw funds without penalty. For example, you might have to wait a week after opening it, or you might only be able to withdraw the full amount, not partial amounts. But compared to potentially losing several months' worth of accrued interest with the traditional CD's early withdrawal penalty, this offers significant flexibility.
This seems like it would be perfect for money you think you might need, but you're not sure exactly when, and it's not your emergency fund. The book gives the example of squirreling away a part of your future baby fund, or maybe saving for a home renovation you plan to do in the next couple of years, but the timing isn't set in stone yet.
Precisely. It's designed for cash you may need sooner than expected, but with some notice. It's very important to heed the caution in the book, though. This is not for your emergency fund.
Why?
Because, depending on the bank, the money may not be immediately available for withdrawal. There might be a processing delay of a few days. For a true emergency fund, you need instant, immediate access, which a high-yield savings account typically provides, but even a liquid CD might not.
Good distinction. And the trade-off for this penalty-free access flexibility, I'm guessing a lower interest rate?
You guessed it. As with most financial products where you get extra convenience or flexibility, it usually comes at a cost in terms of potential return. Liquid CDs typically offer lower interest rates compared to traditional CDs of the same term length. You're essentially paying with potential future earnings for easier access to your money, as the source phrases it.
Okay, makes sense. We've covered flexibility for access and hedging against rising rates. What about the investor who's maybe less risk-averse, chasing higher yield, and doesn't mind a different kind of uncertainty?
That might be the target audience for the callable CD, described on page 104. The source characterizes this one as potentially being for the adrenaline junkie looking to maximize your return and don't mind a little more risk.
Why adrenaline junkie? Because they offer a really top-tier interest rate.
Yes, that's the main hook, the primary attraction. They often offer a significantly higher interest rate than comparable traditional or even other fancy CDs. But, as the source warns, that comes with a price. The risk, the catch, is that the bank has the right to say, "Mine now, give it back." They can call the CD back from you before its scheduled maturity date.
Wait, the bank can just decide to end the agreement early and take the CD back?
They can, yes. based on specific terms laid out in the CD contract when you buy it, the call provisions. If the bank decides to call the CD, you get all your money back plus whatever interest you've made so far, up to the call date. But you forfeit all the future interest payments you would have received if the CD had been allowed to run to its full original term.
Okay, but when would a bank actually do this? Why would they want to call back a CD they issued?
This feature is typically exercised by the bank when interest rates fall significantly after the CD is issued. Think about it from the bank's perspective. If they issued you a 5-year CV, paying 5% interest, and 2 years later, prevailing market rates for new 3-year CDs have dropped to only 2%, they are paying you much more than they need to based on current conditions.
Ah, so by calling back your expensive 5% CD, they can stop paying that high rate. They give you your money back, and then they can effectively borrow new money from other depositors or the market at the much lower prevailing 2% rate. It saves the bank money on its interest expenses.
Exactly. It's like an escape hatch for the bank when interest rates fall sharply. The risk for you, the investor, is that your lovely high-yield investment gets cut short precisely at the moment when reinvesting that money elsewhere would mean accepting a much, much lower rate in the current market environment.
So you get your principal and accrued interest back, which is good, but you're potentially forced to reinvest in a much less favorable low-rate environment, losing out on those high guaranteed payments you thought you had locked in for longer.
That's the core risk. The book stresses that these callable CDs aren't offered by all banks, and the terms can vary wildly. Understanding the specific call terms, including how soon the CD can be called after being issued, is there an initial non-callable period, is absolutely critical before buying one. You need to know the rules of that potential early termination.
Definitely seems like one for the more risk-tolerant investor who understands that call risk in exchange for the higher initial yield. Okay, just one more fancy type mentioned on page 104, the add-on CD. This one sounds like it's for the CD stan, as the book puts it, who wants to contribute more over time.
Yes, the CD type is specifically designed for situations where you, like a particular rate you see today and want to lock it in, but you don't have the full amount you ultimately plan to invest available right at this moment. The source gives the example of maybe having $100 on hand now, but expecting a $1,200 tax refund in a few weeks.
So instead of waiting for the refund and potentially missing out on the current rate, you could open the add-on CD with the $100 now and then add the $1,200 to that same CD once the refund arrives.
Exactly. With add-on CDs, the interest rate is fixed when you open it, and you will be able to add funds on the account up to a limit or a set number of times over the life of the CD. It allows you to secure the rate now and then contribute more funds as they become available, up to whatever limits the specific CD imposes.
That flexibility to add funds later is definitely useful in certain situations. What's the likely drawback? Lower rate again.
You're picking up the pattern. As the source wisely notes, you've picked up on the basic fact that all investments have downsides. The primary trade-off for the convenience of being able to add on funds later is that these CDs often offer interest rates that are often lower than those of traditional CDs of the same term length.
So you gain the convenience of making multiple deposits into the same locked-in rate, but you might earn a bit less interest overall on the total amount compared to if you had just waited and put the full sum into a higher-yielding traditional CD all at once. It's that constant give and take, rinse and repeat, as the source mentions regarding financial product features.
That's the recurring theme. You pay for flexibility or features, usually with a slightly lower rate.
Okay, wow, that's quite a tour through the different flavors of CDs, from vanilla to fancy. Before we wrap up our deep dive into the section of the Money School, the source includes one last quick but important point, an FYI, about evaluating the institution you're effectively lending your money to.
Right, a brief mention on page 104. Banks get credit ratings too, like individuals or companies issuing bonds.
Exactly. Just like individuals have credit scores and corporations get rated when they issue bonds, banks are also assessed for their overall financial health and creditworthiness. Major rating agencies like Standard & Poor's, S&P, Moody's, and Fitch Ratings assign credit ratings to banks.
And why is that relevant for someone just buying an FDIC-insured CD? Does the bank's rating matter if your deposit is insured anyway?
It's a fair question. The source calls the credit rating the bank's financial report card. While FDIC insurance provides that crucial backstop against failure up to the limit, checking the bank's rating can help you understand the risk involved in investing in or doing business with a bank more broadly. It gives you a sense of their overall financial stability and strength. Think of it as part of your due diligence as a lender. Before you peep their credit rating, as the source puts it, it's good to have a sense of who you're trusting your money with, even with insurance.
Good point. It adds another layer to your assessment beyond just the FDIC coverage.
Finally, the source very briefly mentions high-yield savings accounts as another alternative way to earn decent interest on bank deposits, especially when the overall interest rate environment is favorable, like it has been recently.
Right. These also offer competitive rates that often track changes in the Fed's policy rate fairly closely.
And the key difference compared to CDs.
They keep the huge perk of easy access to your money. There's typically no term commitment, no early withdrawal penalties. This makes them, as the source concludes, a great choice for your emergency fund, money you might need instantly, and without any restrictions or penalties.
Right. Unlike even a liquid CD, where access might be slightly delayed or have some rules, a high-yield savings account offers that immediate liquidity needed for true emergency.
Exactly. However, the source also makes a fair counterpoint. For some people, the very inaccessibility of CDs can help keep you invested by simply removing the temptation to withdraw money early. That little bit of friction, that term commitment and potential penalty can actually be a behavioral benefit if the money is earmarked for a specific future goal, and you want to make sure it stays put and doesn't get dipped into impulsively.
That's a great psychological point. Sometimes making it slightly harder to access helps you reach the goal.
It can.
So we began this deep dive acknowledging those common, often negative feelings associated with the word debt, the stress, the burden, maybe even the trauma the source mentioned. We've journeyed through the world of certificates of deposit, using pages 88 to 104 of Nicole Lapin's The Money School as our guide, exploring a key way you can flip that script and actually become the lender, not the borrower.
We've definitely seen there's truly a world of difference between owing debt and owning debt, as the book concludes right there on page 104.
Owing debt typically puts pressure on you. But owning debt, particularly owning a certificate of deposit issued by a bank,
You guessed it. Makes you the bank. That's the final empowering thought from this section.
it's a really powerful perspective shift. We've explored the core concept of traditional vanilla CDs, understanding their guaranteed nature, their fixed rates, and the absolutely crucial protection offered by FDIC insurance, which, as we discussed, feels more relevant than ever after the events of 2008, and more recently, the failures of Silicon Valley Bank, Signature, and First Republic in 2023.
We've demystified how banks actually use your deposited money through fractional reserve banking and how they profit from the interest rate spread. We've tackled the main risk inherent in traditional CDs, inflation eroding your purchasing power, and learned how practical strategies like the CD ladder can help mitigate that risk while also providing valuable planned liquidity.
And we've peeled back the layers on several of those fancy CD variations discussed in the book, the brokered, jumbo, bump up, step up, liquid, callable, and add-on CDs. We've seen how each offers different features, maybe enhanced access, maybe flexibility on rates or structured payouts, but also understanding the specific trade-offs, risks, and scenarios where each of these more specialized tools might be useful.
Yeah, this detailed exploration, drawn straight from those specific pages of the Money School, really provides a solid foundation for thinking about how CDs might fit into your own financial picture. It encourages you to look beyond just the basic definition and consider how these different types of CDs could potentially align strategically with your personal goals, your tolerance for risk, and maybe even, as we touched on, some of your financial anxiety.
Absolutely. So for you, the listener, take everything we've covered today, all these details about terms, rates, FDIC, inflation, ladders, fancy options, and think about your own situation. What are your financial goals? What's your timeline? What makes you feel secure with your money? And what makes you feel anxious? We've seen that CDs come in many different variations, far beyond just the simple, straightforward, vanilla type.
The traditional CD offers that baseline simplicity and certainty. The latter provides structure, a hedge against rising rates, and that valuable planned access. And then these various fancy ones offer really tailored features designed to address very specific needs or preferences or market outlooks.
So building on that, here's something for you to really chew on as we wrap up. Considering all these different types of CDs we explored from the book The Brokered, Jumbo, Bump Up, Step Up, Liquid, Callable, and Add-on, which specific feature from one of those fancy CDs feels most strongly aligned with addressing one of your personal financial anxieties? Or perhaps helping you achieve a specific goal you have in mind, and why?
Yeah, think about what resonates. Are you someone who worries about needing the money unexpectedly early, making that penalty-free withdrawal feature of a liquid CD particularly appealing?
Or do you have serious FOMO about locking in a rate just before rates shoot up, making you lean towards the potential adjustments offered by a bump up or step up CD?
Or maybe the idea of making phased investments into a single CD using an add-on structure perfectly fits your anticipated cash flow from bonuses or tax refunds.
Or does the potential for higher yield with a callable CD appeal to your risk appetite, even understanding the call risk? Think about which specific problem one of these fancy CD features, as described in the Money School, might actually solve for you and your unique financial personality.